Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's June the 16th, 2017. Trust everybody's looking forward to a wonderful summer season. Now, on today's update, I want to just deal with three items. First, politics in Ottawa. Second, the Paris Agreement. And third, the recent increase in interest rates south of the border by the Federal Reserve. So let's go through those one by one. First of all, as many know, the Conservative Party of Canada elected a new leader, and I think this new leader is going to be very good for the country. And that leader's name is Andrew Scheer, and he's providing already good, healthy opposition in Ottawa. Now, in celebration of a new leader, I had a hat put together here, and my own Scheer hat, Make Canada Great Again. And so let me just outline for you 9 reasons why I'm enthusiastic about Andrew Scheer and the pushback that he's giving in Ottawa and the issues that he's focusing on that should be very important to Canadians and to investors who are concerned about wealth creation and wealth protection. So 9 reasons why I am very positive in terms of Andrew Scheer. Number 1, he believes in smaller government. He actually trusts the people to manage themselves rather than the government to control people's lives, which we actually are seeing a tremendous amount of intrusion into the lives of individuals across the country, both provincially and federally. Second, he believes in balanced budgets and fiscal responsibility. You do not create wealth by going into debt. Number 3, he believes in lower taxes, and that means a more vibrant private sector, and it's the private sector that creates wealth. And so this is also very important. Number 4, Andrew Scheer is very much supportive of allowing MPs the freedom of conscience when it comes to voting. We should not tolerate any government that imposes top-down mandates on their MPs in terms of how they are to vote and does not allow freedom of conscience or the interests of the various constituents that are represented by the various MPs. So this is a big problem and very much a top-down heavy approach that we're seeing across many of our governments in the Western world and certainly in Ottawa currently. Number 5, I should say, he knows how to properly identify terrorism, and he has a moral framework to call out evil. And this is very important in the world in which we live, where there's so many risks and so many evil people. We need to at least be able to identify who they are. Number 6, he supports a strong and well-financed military to protect Canadian sovereignty and also to support our allies. Number 7, he believes that Canada has an identity, and that identity is based in our unity of principles, which gives us strength, not diversity. It's great to have diversity of ideas and people, but ultimately there has to be an agreement on foundational principles in which you are going to govern, or we are going to see much more conflict and much more violence in our own culture, which has been quite a sane and sensible place to live, Canada, with tremendous civil obedience, and this is changing, and so we need leadership that will unify the country. Also, he believes in a strong charitable sector. Charitable entities are very important to a country, and the Conservative Party, and Andrew Scheer in particular, values the charitable sector, and that would be the 8th reason. And then the final reason I'll give this morning in terms of an update, number 9, is he supports families and parental rights. Children are not the property of the state or the government, and the recent legislation, both provincially and federally, is taking away the rights of parents at an astounding rate. And this should be concerning to any Canadian, and certainly people with children, but should concern all Canadians, because government is not should not have the rights over children, nor are they good custodians of children, as we have seen repetitively down through history. So those are 9 reasons why I'm really enthusiastic about the new leadership and the opposition, because it's always good to have a healthy opposition in Ottawa where you've got a vibrant and strong ideas coming forward that will hopefully capture the minds of Canadians and enhance the richness and the vibrancy and the prosperity of this country. Now I want to talk in the second place about the Paris Agreement. This is great news that President Donald Trump has exited the Paris Agreement. As many people know, or should know, that this Paris Agreement had very little to do with the environment and had everything to do with increasing the size of governments and global governance and regulatory bureaucracies all around the world. And most people, if they looked below the layers, could see this agreement was going to strip tens of trillions, and it still will, because most countries are still abiding by it, strip tens of trillions of dollars out of the hands of industrialized countries and put it into the hands of global elites. It will not go in and help impoverished countries. It ultimately will go in to enrich those bureaucracies and the people who are administering all of these regulations and the changes that they want to impose on the global economy. Now, I want to give you a couple of statistics here, and we've outlined those statistics below this video so you can read them. But here's a couple of statistics that come from some very excellent sources, including the UN itself. First of all, if you take the United States and you take Obama's Clean Power Plan, which he had, and if it was actually implemented all the way out to the year 2100, so the end of this century, the net effect on temperatures would be a reduction of 0.023 degrees Fahrenheit, virtually nothing. Second, if all of Obama's initiatives were put into place, so this is where all of the initiatives that he had suggested, which goes way beyond just the Clean Power Plan, and they were held out to 2100, so 2100 to the end of the next century, the impact would be a reduction of 0.057 degrees Fahrenheit. That's equivalent to about 8 months of so-called postponement of what's going to happen. I mean, it really is like it's got virtually no net effect. If the rest of the world, forget just the United States, the rest of the world followed the Paris Agreement and implemented it perfectly and put it into play and reached all of the targets by 2030 and then held those targets till the end of the century, you'd have an impact of 0.03 degrees Fahrenheit on the global economy. I mean, you're talking virtually nothing. So what does this all cost? What does this cost? The cost and the projection of the cost would be between $1 and $2 trillion a year to implement. And that's equivalent to 1.5% to 2% of the global GDP every year. And so you're talking here about upwards to $100 trillion US dollars in order to move temperatures 0.03 Fahrenheit, according to their little measures. Come on. I mean, the real solution here is private enterprise. It's investment in technology, which is already taking place. It's putting money into initiatives and innovation, which is already taking place. It's not putting money in the hands of government. And so when Donald Trump walked out of this agreement, he made a very prudent decision, a very wise decision, and actually one that will enhance not only the United States, but it'll help, hopefully, the global economy by putting money where it should go if it actually wants to deal with any of the environmental issues. And of course, we want a clean earth and we want clean energy and all of these things, but they're only going to come as a result of great investments in the vibrant private sector in making those investments. And so we should be angry that all of these other governments, including ours, are prepared to strip money from us and to put it into bureaucracies that are inefficient and ineffective and won't solve any of the environmental issues. Third, just briefly, the Federal Reserve increased interest rates on Wednesday, the 14th, of June, 2 days ago, by 25 basis points. And they've also laid out a program to start to tighten up the quantitative easing. In other words, reverse quantitative easing, the printing of money, which I would call then they're going to quantitative tighten. And so this is interesting. This is the third time that the Federal Reserve has put interest rates up a little bit in the last 18 months. And so they are trying to normalize the monetary conditions, which have been very fluid and way too easy, as we've talked about. Now, the problem is the Federal Reserve has printed about $4 trillion. And this is just the U.S. Federal Reserve. We're not even talking about other central banks around the world. So they've printed about $4 trillion, and pulling that back is going to be difficult. Increasing interest rates in an economy which has got so much debt is also going to be difficult. And so I'm not going to make any predictions on how this is all going to work, other than to say the following. And these are the points that I want to make and emphasize in terms of an investment and what we're doing on the investment side. Given increasing rates, given the fact that they want to pull money out of the economy, they want to retrench or retrace some of the printing of money that has been engaged in, we think we've got to be very, very careful, very vigilant, because the majority of times when the central banks are doing this, it does lead to volatility in the stock markets. So here's just 4 quick points that we want to make in terms of how we're approaching this from an investment perspective. First of all, buy high quality assets, well-financed balance sheets so they can weather volatility. Number 2, focus on valuations. Increasing interest rates will put downward pressure on the value of all financial assets. This includes stocks and bonds, and therefore we need to be very careful about the valuations and what we're paying, and also keep our term on our bonds, the length of our bonds, short term, so that we can reinvest at higher rates and we're not caught with a downward price movement in our bonds. Number 3, expect more downward pressure on high dividend paying stocks as interest rates rise. So temporarily, as rates come up, stocks with high dividend yields might come off a little bit, but that's fine. We're going to stick with those as long as they can grow their dividend over time. The stock prices will normalize and we'll chug along just fine. And then lastly, 4th point, the global economy is awash in debt, and increasing interest rates could precipitate a major financial crisis in the global economy. And so we need to be prepared for some problems, and therefore we keep some cash on the sidelines. We invest in businesses that are very defensive in some cases, including some of the precious metals companies where we have leading royalty and finance companies in that space. And these companies should operate as offsets if things get a little messy while they're increasing interest rates. So those are the 3 items that I wanted to cover off with you today. We're excited by the new opposition party in Ottawa to be able to keep the existing government a little more honest, hopefully. Second, we continue to be very much appreciative of Donald Trump exiting the Paris Agreement, which is just a regulatory and government boondoggle. And number 3, we're being very careful and defensive as interest rates start to move up. If you have any questions, let us know, and trust that was helpful. Thank you very much. Bye now.